Okay. We never really know when you're like going live here, but I think we're live. So welcome. We're just getting together today. I've got a couple of really awesome guests here in the office today that we're going to be talking to. Mr. Eirik Rorvig of Guaranteed Rate and Randy Rueth of We Insure Badgerland. Couple of great industry professionals that we're going to chat really quick today. Eirik's going to start things off. And I'm Dan Bertelson with Remax Preferred, one of the owners here at the large Remax franchise in South Central Wisconsin. So if you're visiting our little broadcast here from anywhere else in the country or in the world, you know, we're on that World Wide Web thing. Hi, hope you're doing well. The sun is out, we're above freezing, and life is good here in Wisconsin. But the housing industry is, man, the inventory is low. There's a lot of stress. There's a lot of things going on. Eirik, why don't you kick things off? I know you wanted to talk to us a little bit today about the home lending, like the qualified mortgage, rule changes, how they're going to affect our industry and everything. And I think it's really important what you have to say. So sure, take it from there, sir.
Okay. So as of January 1st of this last year, there was a new qualified mortgage rule that was passed. And it was actually suspended because of COVID. And they was supposed to go live again at the end of March, and then it got suspended till July 1st. Now it's hard and fast that how you qualify for a mortgage is going to change starting July 1st. So some of this little background on this is it traditionally, when you qualify for a mortgage, it has three major components, right? It's your credit score, it's how much money you're putting down, and then your debt load. Right. So your debt to income ratio, which is quite literally the amount of your debt in relation to your gross wages per month. That's going to change a little bit. We don't know exactly how much that's going to change. We don't really have a lot of great guidance on that quite yet. But what we do know is that when you have a mortgage, you have what's called an annual percentage rate. Annual percentage rate is the total cost of doing the mortgage. It's all the costs and all the interest amortized. Amortized means spread out over the life of the loan. Meaning if you have a 30-year loan and you carry it for 30 years, if you lock in at like 3.5%, then what you actually paid for, it's probably 3.75 or 3.8 or something like that, right? So it's a little more than the actual interest shows in your interest rate.
Hey, Randy, isn't that why we have bankers? I mean, just right there.
Somebody give us all the numbers, right?
So how this changes a little bit is the new rule says that the debt to income ratio may or may not actually play a part in the qualification. It has more to do now with, does the APR exceed the average offer rates called the APOR, which sounds very similar, but they're very different things. It's the APOR plus a margin. Now the APOR is set not by anybody lending money. It's average prime offered rate. It's a surveyed grouping that comes together. So right now it's 2.76. The margin is 1.5. So as long as your APR stays under 4.25, because it's two together, then you still qualify for the mortgage. And that's, as far as I understand, that's still going to be the same thing moving forward. Now, because the rate environment is so low, almost all mortgages fall under that margin. And what that really means is that if you have an investor like Fannie Mae or Freddie Mac, actually the whole thing is exclusive to those two investors. That means that they will buy your mortgage. They will essentially give you the money to do the mortgage, right? And if you exceed that, then it's called a rebuttal margin that they can, lenders can go to the investor and say, hey, we should still be able to do the loan. That rebuttal is also going to change a little bit. Now, how does this affect, conventional borrowers? Moving forward, they are changing how much investment is going to be available for conventional mortgages based on a rolling 52-week period. And in that 52-week period, I don't know what the total ratio is, but the ratio can't exceed two high risk factors. And so high risk factors, according to FHFA, which is the oversight committee for Fannie Mae and Freddie Mac, says that a credit score below 680, a debt to income ratio of 43% or higher, or 10% or less down. So the total portfolio can't exceed two risk factors based on a specific margin within the portfolio. And what that really means is at some point, if it does exceed that, they're going to cut off investment for that. And so what you're going to see is a migration. I think you're going to see two things. One, you're going to see a migration from sort of middling borrowers, sort of in that 660, 670 range. You're going to see more of those going to FHA, because this doesn't, on any of the thing that's a HUD or VA that doesn't qualify for this, like these changes, they're going to be exactly the same as far as
they're essentially still going to be exempt.
Yes.
Yeah.
Well, they're different. They're not under FHA,
Got it.
FHFA or a conservatorship. So this is a different thing altogether. But for conventional mortgages, you're going to see probably those people migrating to an FHA. So you're going to see more FHA borrowers in the market. You're going to see investment in second home money probably diminishing quite a lot, and cash out refinances as well are going to be
Really
hard, because they're not going to be that APR threshold. They're
So if I were to throw into, close that a little bit. If I were to throw this into some layman's terms for myself, then not affordability, but availability of financing is definitely tightening. I mean, it's going to be harder. And who do you? I mean, we can't say exactly who, because you just said the stipulations are involved. But I mean, who does this affect the most? I mean, does it affect us all as a whole? Does it affect? I know you just said the second home buying market, which I mean has been on fire,
and investments.
That's
investments.
The biggest one. Okay.
Yeah.
Interesting.
Yeah, because so one, it's the APR rule that's going to tighten things down, because the truth of it is, if you buy an investment property, it's already more expensive to do. There's adjustments to do it. I'm gonna stop it.
Sorry, I didn't know that was. I didn't know that was going to happen to you, Eirik.
That's
Sorry,
okay,
buddy.
It's okay.
That's what happens when you're live, folks.
So it's already harder to do. Interest rates on investment properties are already higher. And by the way, this is not for multifamily. This is for single family only.
Oh, okay. Good.
So far,
all right.
So far, that might change. It's already more expensive. The interest rates typically are higher, or you pay a lot of adjustments or points to get it. So it's additional money up front that you're prepaying. And so when you do your APR, if you're locked in at like 3.5 and you're paying a bunch of points, there's a very good chance you're not going to hit that threshold. You're not going to be under it, and therefore you're not going to be able to do the money. So that's part one. Part two is they cut their total second home and investment property portfolio margin from 14% to 7%. And by the way, it's a rolling 52-week average, which means if they hit that mark, money's gone. You could be locked in.
Wow.
You could be ready for closing. It doesn't matter. Money's gone.
Oof.
So what that really means, in my personal opinion, is we're going to see lenders coming up with additional overlays or things that we have to do to ensure that we're not making these high-risk loans, or you're going to see private investment instead of Fannie and Freddie investment. So things are going to change in the landscape of lending and who's investing the money to do it. So that what that means, really sort of short-term, long-term, is FHFA wants the government to get out of lending investment money and second home money and doing cash out refinances. If you read between the lines, that's exactly what you can see. FHA is gearing up to take it on. Actually, the FHA head came out. They have 3 times the amount of money that they need to have in there to function on an annual basis. They could reduce mortgage insurance factors with the excess money, but they've decided not to do that because they know there's a deluge of mortgages coming in. They have to insure.
Got it. So they're actually, for lack of a better term, they're well prepared.
They're prepared.
Yeah.
Okay. FHA is really prepared. VA is also really prepared. And then we're going to see, we've already seen a lot of what are called non-qualified mortgage offerings, these companies that are private investment.
We've seen those before, haven't we?
Well, they're back.
Okay.
They're back in full force.
Okay.
And some of them will be good and some of them will be bad. And that's why you need a qualified mortgage professional who deals with them to understand exactly what's going on.
Well,
and to put you in, not to put you in a weird position 3-4 years down the line.
Yeah, I think it's important, like as we're sitting here talking about today, and that information, I know for some people will go right over their head. And for some people that are, well-versed in the finance, so they'd be like, oh, that's really, really interesting. I can see how that could apply to me. at the end of the day, this is a telltale reason why, having somebody experienced and, to help you walk through and to look at all the different options. And not only that, the different scenarios of how this could affect you down the road, right? Because I mean, if you're not doing that, you're just looking at whatever's getting put in front of you because of the frenzy of this market. Be wary of that, right? You need to be cautious, not about just today, but you need to look into the future too. Randy, I'd like to introduce Randy here too, and we'll come back for some questions and we'll see if anybody asked any questions online or whatever. And of course, if you have questions later on, feel free to put them in the comments. We'll jump on and make comments and everything else and whatnot. Randy Rueth is an insurance professional, experienced long time here in the greater Madison, South Central Wisconsin area. And I don't want to take anything away from him. He's licensed in several states. He can help some people out. But Randy, why don't you introduce yourself? And then I know you were going to talk a little bit too, just about, people's overall insurance expenses. And yeah, some advice there.
Yep. So as Dan mentioned, Randy Rueth from We Insure Badgerland. I am currently licensed, obviously, in Wisconsin, Iowa, Illinois, Texas, and Florida shortly. For those of you with second homes out there, you should still be able to hit some. As we've seen recently, as people are, the housing market's tight, the purchase prices of the homes is going up, and we're trying to find every dollar that we possibly can. One of the avenues you can do this is through the insurance. An independent broker, we've got a number of options to look at: home, autos, umbrellas, maybe bring down some of that monthly debt and get a better debt to income ratio to help qualify for that loan for the house that you're looking for.
It matters right now, right? I mean, every little bit matters. And I apologize. I know we got a tiny delay on your end. Right now, and we've had lots of clients over just the last couple of months, they needed an extra $50 a month here or there to get them in a competitive market. They're quite frankly, they're getting smoked by competing offers on properties, and they needed to go find some more monthly income. And a lot of people are like, well, I don't have time to go get a raise or a new job or whatever. And it's like, are you looking at some of your primary expenses? And one of those places we've been easily able to go find people some savings and get them, requalified back up so they can compete at a little bit higher levels of insurance. So I really thank you for being here. I thank you for partnering with us too. Randy, I'd also like for you to talk a little bit about what's changed a little bit the last few years. I personally had a property that had a sewer lateral go bad in the last couple of years. And I wasn't really covered for it. It was between the actual road and the building, and depending on where you're at and whether it's your primary home and a lot of people aren't able to or don't inspect for the age of some of these things. And, they don't do that check. They might look the house over really well with a great home inspector or whatever, but is there anything you can say about that?
Yep. So the insurance carriers over the last couple of years have added a few coverages that don't automatically end up on the policy. They're endorsements or add-on coverages that need to be selected. So if you purchased your home 3-4 years ago, there is now service line coverage. And for those of you, when you're hearing service lateral, it's essentially the waste pipe going from your home, usually to the center of the road. That was considered outside the home and not covered under insurance. There is an endorsement now on policies that pick up generally anywhere from $10,000 to $20,000 worth of service line coverage. They've now added equipment breakdown coverage. So think wear and tear, which was also never covered under policies before. They have also now picked up some cyber liability as well. So these things, if you purchased a home 2-3 years ago, you may not have had the option to do it then. And many people don't look at their policies kind of going forward. They assume they're okay. And that coverage isn't on there. And now it's available. So it's
right on.
Another reason other than budgetary reasons to maybe reach out and have us take a look at the policy.
Well, and I know your information's down in the comments. Give Randy a call or go to We Insure Badgerland. And I know, Eirik, your info is down in the comments as well. Feel free to throw your guys' websites on there, after the call here or whatever. Randy, I know you've been doing a lot of, business owner policies and stuff like that too. And I think you just hit on it for me, but me personally here at Remax too, it's like digital fraud became a bigger thing, and everything. And it's amazing to me how many small business owners that are transacting money, via email and like through these different things and obviously sensitive information like Eirik has to deal with. Like they have a lot of systems, I know, because I actually used his services recently to refi my home and did a VA. And it was like, man, we had these really secure ways, but it was like, I knew we were squared away, but we've been running into some businesses the last couple of months. So my fellow business owners that are out there, if you haven't looked at your business owner policy in a long time, or you don't even have a business owner's policy for your business, or something like that, also give Randy a quick call. We're going to wrap things up here. Guys, first and foremost, thanks for just knowing your craft and being a great resource for not only myself, but for all the agents at Remax and just all the people here in Madison. Eirik, I know you work with a ton of real estate professionals, you too, Randy, and that's the world I come from, but I can't know all this stuff. I encourage everybody in their individual professions to reach out to the other people that are, co-industry professionals and stay educated, man. There's so much changing right now across so many different fields. Don't go at it all your own. Make sure you have somebody that knows what the hell they're doing, fixing up the parts of your life that they pertain to.
And I would say, Dan, just to interject, especially coming out of COVID, because lots of things are going to change as a result of this. Obviously, I'm a money guy, so from an economic standpoint, lots of things are going to change. The whole landscape of money is going to change as a result of this and moving on, and especially as the country opens up back for business, things are going to change. So, from a mortgage standpoint, things are definitely not static this year. They're going to be fluid. We're going to try to keep up with the changes as much as possible. I mean, even though we're talking about the QM changes, we don't fully know exactly what everything's going to be.
Well, and the appraisal timelines are changing. Everything's changing, right?
Everything's changing. So it's important. I think, if we're talking to just real estate professionals, like if you want to be top of your game, you have to know exactly where those fluid points are going to be and how to access it and utilize that. Because they are, I mean, what was it? Appraisals like 2 weeks ago, we could get a rush appraisal in under 10 days. And now a rush appraisal is 17 days.
Yeah. It's pretty crazy. And I mean, you just gave me the perfect interlude for the last comment I was going to make, which is the expectations in this market that you need to have of other people. Those need to be fluid because the constraints that we're all working under, and this isn't industry specific. I'm talking about human beings now. The human beings and coming out of COVID, certain people's comfort levels. I already know I have dear friends. I'm vaccinated. You guys are vaccinated. Like there's this feeling, of like, let's get back to normal. There's other people that are still not ready to get back to normal. My kids are back in school. Things are changing for me and my wife, like everything, right? On every level, there's so much change going on. I guess I wanted to leave things off more on that human standpoint of give everybody a break this year. Give everybody a little bit more time and don't react the way, maybe we typically would as quick as we would, right? Give everybody a little bit of a break. As far as the low inventory, and this will be my last comment about business stuff. And then we'll announce our awesome winners for our March Madness bracket and get out of here. But guys, the building materials costs for housing was coming back down, and things were like I was a little bit more optimistic when it came to the building materials costs coming, starting to retreat back down, and now they've gone skyrocketed right back up again with the spring weather, with everything else that's going on. They're not likely to retreat. And the builders are doing the best they can with as much labor as they can. The demand is still extremely high. We're going to have to exercise some more patience with everybody across every industry, but make sure you're looking at all of your options. If somebody is not giving you the service that you need, or you're not getting the answers, give them that patience I was talking about, but also look at other options. If you haven't looked at, this builder or that builder. Like, look around. Somebody else might have some more availability in a different area. Don't, I guess, look in too small of a scope. You'll probably be extra frustrated, but to think that you'd be able to go in and negotiate on a property right now, you do still have to somewhat negotiate, but we're using such different strategies and tactics today than we were just 8 months ago, and even 8 months and 12 months before that. Again, experience matters. Okay. And I don't care which profession we're talking about, whether it's insuring your business, your home, doing something with Randy, whether it's getting lending or financing advice. And we don't have a financial advisor on here today, but that's, a piece that I'm involved with. June Brown, little shout out to you. But we need advice from these people because of how quickly it's changing. But more importantly, because if you're making the wrong decisions now, it can certainly affect you later. So that's my last little stumping piece.
One other thing.
Go ahead. Oh, and sorry, Randy, Eirik, anything else to add before we jump off here too?
Sorry, just going to piggyback on your point about giving other people some latitude. Give yourself some as well. Give yourself a little bit of grace, because when you're dealing with other people and things are heated and things aren't going your way, right? I mean, it's easy to just get super involved and wound up in it, and it doesn't help anybody. I mean, I'm guilty of it too.
Right.
But because of the speed of everything right now, sort of had to reflect on myself here the last month or so and give myself a little bit of leeway, right? I keep a lot of pressure on myself to make things run and do things.
It's a control thing, right?
It is a control thing.
You can only control what you can control. I think at least I know you gentlemen and the gal in the background we've seen a couple of times behind Randy there. We're trying our best every single day to do our best. Randy, do you have any parting words, sir?
Yeah, it just made me think about, as we were discussing the building costs, I'm seeing, the number one line on your home insurance is like, this is the amount of money you have to rebuild your home. And different carriers do it different ways. But that's a huge issue right now. If something happens to your home, is there enough coverage on your policy to cover it with some of the prices that are out there? And seeing some anywhere between 2 and 4 times the normal cost of a 2x4.
I know.
We had looked at a piece of plywood, and it was like 2.5 to 3 times the normal cost. Well, that's going to directly reflect in your home's rebuild if something happens today.
It's a major good point right there too. I mean, when I used to hear $200 a square foot building cost, that was for I thought you would be building like a little mini, Las Vegas casino style home, marble, and people would come shooting out of a fountain when you got home, or something like that, and now $200 a square foot, it's like, that's going to get you this, don't get me wrong, it's going to get you a lot these days, but $120 a square foot 10, 15 years ago doesn't exist for anything but maybe a shed build or something. I don't even know. It's just not there. And then of course, and we'll get into it on another call, but commercial build out, commercial retail, we've got a lot of trauma and drama coming in the commercial side of things, which we'll touch on another day when I get Joe Vole on and some commercial folks. But thank you guys both again for being here. Thanks for having us. It's been a great little 20 minutes here. And we had our March Madness bracket winners. So I figured what the heck at the end of the video, since the 3 sponsors that are here on Remax, we Insure, Badgerland, and Guaranteed Rate sponsored a little mini, little March Madness bracket. And out of the folks that we had in the company, Kelly Stelzer, my man, you won first place. Man, did you eke everybody out there at the end with with the Baylor win, right? And just getting that first place. Tim Krueger, you came in second place, my friend, and Chris Huemmer on the Huemmer home team there in Cottage Grove, you got third place. So thank you from all of us for submitting a bracket. It was that impromptu thing in March that a lot of us always do, but I don't know, man. It always makes me ready for spring, and I just appreciate you guys volunteering the prize money, and certainly Randy for running the online portion of it, and Eirik organizing the names. So thank you guys so much. Appreciate that.
You're welcome.
Cool. Well, you guys have a wonderful day out there. Oh, sorry, I missed the one comment. Don't know who it is. They just said hey. So hey. Oh man, that's great. Everyone have a wonderful day. We'll talk to you later.